Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is your host, Steve Meisinger. Today, each and every week, of course, at the ISE, we do these weekly webinars. So today we have Nicole Wachs with us, and she'll be talking about improving your odds when trading FX options. Nicole is an options analyst and a director of education at TradeKing. She's a former market maker, and she's going to show you how to look at implied volatility and strategically look at, how you can trade this, how you can really understand how it all works. She'll show you the functionality of the TradeKing website. Again, you're going to need to have an ability to access the ISE. So TradeKing is one great broker that you'll be able to do that. Nicole worked at the American Stock Exchange. She also worked at Goldman Sachs as a market maker and traded at the ISE. So without further ado, I want to welcome Nicole Wachs. Nicole, thank you so much for joining us. How are you?
I'm great, thanks. How are you doing this evening?
I'm doing great. We have a nice big crowd, and I checked out your slides. They really look very, very informative. Being a former market maker myself, I didn't know that you were at Goldman Sachs. I was also for a period of time, so we came from the same firm. I'm really looking forward to this presentation. So why don't you take it away? Again, this is Steve Meisinger, your host, and we have special guest Nicole Wachs with TradeKing. So, Nicole, take it away. Thanks again.
Great. Thanks again, Steve. That was a great introduction. Welcome, everyone. Thanks for having me with you this evening. And I hope that I can shed some light on some things that should be able to help you improve your odds when trading FX options and also when trading other types of options. Many of these things can be applied to other products as well. Just a couple quick disclaimers. Options involve risks, and you need to be aware of what they are. Please read a copy of the characteristics and risks of standardized options. You can access it at the ISE website or at TradeKing.com. And these are for your benefit, but for educational purposes only. TradeKing, and I'm sure the ISE does not offer any recommendations or give advice. Okay, so for those of you who have not heard of TradeKing, we've been around over 3 years now. We are tearing it up on broker surveys and new accounts and new customers and happy clients. So if you haven't heard of TradeKing, we'd like you to check us out at TradeKing.com. We have great rates, $4.95 a trade, plus an additional 65 cents for options contracts. We don't have any minimums and no gimmicks. We're also very integrated into the social networking aspects of technology, and we're on Twitter. We also have our very own trader network where you can interact with other traders. So check us out at twitter.com/TradeKing or /Nicole Wachs for updates from both parties. And we also have a webinar series. If you haven't gotten enough education tonight from 4:30 to 5:30, you can join TradeKing's session starting at 6, available at webinars.tradeking.com. We also have a special Rookies Corner. That's our term for beginners, and those sessions are held on the last Thursday of the month at 8 p.m. And of course, they are always free. So as you know, the ISE has a great product. There are 6 pairs of FX options that they offer currently. Australian dollar, British pound, Canadian, so on. And what we're going to do is use some examples to illustrate some things that you might not be putting together when you're coming to a decision about what to trade and when to trade it. So without further ado, let's get to the topic at hand. And just to kind of give it a broad overview, there's basically three ways that retail traders, and we're all retail traders now because Steve and I are no longer on the floor, so we are amongst the rest of our clients. And so there's basically three ways that people are trying to affect a strategy. Either they're trying to take advantage of the stock moving in a certain direction, they may be trying to collect time decay, or they may be trying to gauge the direction of implied volatility and make a play that way. Now tonight I'm going to be speaking mostly about implied volatility and things that you can look for to help you get a better handle on that. So then that brings the question of, well, what is implied volatility? So implied volatility, whenever you hear the term implied, it means options, pretty much as far as the scope of this discussion goes. Okay, and often outside of this as well. And so what we're not talking about here is historical volatility. Historical is another word. You could substitute a couple different words in there. Statistical volatility, stock volatility. Basically, that's measuring the movement of the underlying price. We're not going to be talking about that. We're talking about the implied volatility, and that is something that you can only get by using an options pricing model. So basically, it's backed out from what is the current price of the options using a pricing model, and this X number of implied volatility comes out. The thing that I'm going to be focusing on here, though, is that there's a certain behavior that implied volatility seems to follow, not all the time, and not on a schedule, but and that's called mean reversion, meaning that it kind of moves like a rubber band. You know, if you stretch it up too far, it wants to come back down. If you stretch it down too far, it wants to come back up. It wants to come back to some middle ground. And we'll get into that in just a moment. So a couple other things. For me, I'm big on, well, how is this information going to help me make money, right? Because that's why we're all here. We're trying to make better trading decisions which will affect the bottom line of our accounts. So to put it in layman's terms, or things that are more concrete, is that implied volatility is basically telling us about the supply and demand of the options. Okay? And there's different things going on with that. So there are two things that can happen: higher demand or lower supply, right? Both of those can send prices higher. And things are no different in the options market. So if you get higher volatility, that's going to give you the higher option prices as a result of, as we said, higher demand and or lower supply. You can get both or just one of those two. So the question is that a better time to do a certain thing, to either buy or sell? What about if it goes the other way? What if we're talking about lower demand and higher supply, right? To think about all the cars on the dealer lots these days, right? Demand is down and there's too much supply to go with it. So prices are down. So how do we recognize that in the options market? Is we look at the implied volatility number. The lower the implied volatility number, it's saying that the option prices are lower. So then the same question applies: is it better to buy or sell? Well, it's going to depend, and we're going to get into that.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.